Welcome to this explainer. I am so glad you're here. Look, if you've ever felt like the financial world is literally speaking a different language, or if you've been sitting on the sidelines thinking, man, I need a finance degree to start building wealth, you're in the exact right place. Think of me as your personal financial mentor today. We're going to go step by step on how to start investing in the stock market in 2026. Now, our goal here isn't to get rich by next Tuesday. Nope. Our goal is to build a highly effective, automated, long-term wealth machine together. We're going to break down the exact mechanics, the specific accounts you need, and the mental armor required to protect your hard-earned money. So grab a notebook, get comfortable, and let's start building your financial future. Okay, let's dive into this. Because this right here is the fundamental reason why we absolutely have to invest. A lot of people think that the safest thing they can possibly do with their money is to just leave it sitting quietly in a traditional savings account, or, even worse, stuffed under a mattress. But here is the painful truth. If you're doing that, you are actively losing money every single year. Seriously. Why? One word: inflation. Every year, the cost of living, your groceries, housing, energy, it goes up. If your money isn't growing at a rate that outpaces inflation, your purchasing power is shrinking. That $100 today, it's going to buy you significantly less 10 years from now. We don't invest just to get rich. We invest to survive the silent tax of inflation and protect the value of our hard work. But there's a massive wealth gap we need to address. And honestly, it's largely based on a total myth. According to recent consumer finance surveys, about 58% of all U.S. households have some form of investment in the stock market. But when we look at the Hispanic community in the U.S., that number plummets to just 28%. That is a massive gap. So why does this exist? Well, for generations, there's been this persistent myth that the stock market is exclusively for the ultra-wealthy, or that it's some closed-off VIP club for Wall Street experts. That is entirely false. Today, the tools to invest are available to everyone, whether you have $5 or $5,000. You don't need to be a financial advisor, and you definitely don't need a massive inheritance. You just need the right information. Section 1. The traps. What not to do in 2026. So before we learn how to actually make money, my job as your mentor is to teach you how not to lose it. The financial landscape is just filled with noise right now, especially on social media. I mean, there are countless voices promising you astronomical returns with zero effort. But if you don't know what to avoid, even the best investing strategy won't save you. Listen, there is a massive, fundamental difference between day trading and long-term investing. Day trading involves buying and selling stocks rapidly, trying to predict short-term price movements. It is incredibly high risk, incredibly stressful, and statistically, the vast majority of day traders actually lose money. It relies on a total gambling mindset. Long-term investing, on the other hand, well, that's what we're focusing on today. It's low risk, it relies on the steady upward trajectory of the global economy, and it is passive. You don't have to sit in front of 6 computer monitors sweating over every single tick of a stock chart. Long-term investing is simply about buying quality assets and letting time do the heavy lifting. Let's look a little closer at these 4 common beginner errors. First up, treating the market like a casino. If you're buying a stock just because you have a feeling it's going to pop, you're gambling, not investing. Second, chasing fast returns. Real wealth is built through patience, not overnight miracles. Third, blindly following social media gurus. The ones selling $600 courses claiming they have this secret formula to beat the market. Honestly, their only secret is usually taking your $600. And fourth, and guys, this is absolutely critical, never, ever invest money you will need tomorrow. If you need that cash to pay rent next month, it belongs in a bank account, not the stock market. The market fluctuates, and you've got to have the staying power to ride out the dips without being forced to sell at a loss. When it comes to investing, perseverance and discipline will beat extreme intelligence every single time. Section 2. The 2026 Blueprint, your step-by-step guide. And this brilliantly illustrates just how simple the logistics of investing have become. It has literally never been easier. Today, your wealth machine can be broken down into 4 simple mechanical steps. No guesswork, we're just going to follow the blueprint. First, we open a secure brokerage account. Second, we route our money through the smartest tax accounts available. Third, we buy a specific type of asset called a broad index ETF. And fourth, we put the whole shebang on autopilot with automated monthly contributions. It's a true set it and forget it strategy. Let's break each of these steps down so you know exactly how to execute them. Okay, for step 1, you need a broker. Think of a broker simply as the supermarket where you buy your investments. You want to choose a reputable SIPC-insured broker, places like Fidelity, Charles Schwab, Vanguard, or eToro. SIPC insurance just means your assets are protected up to $500,000 if the brokerage itself ever fails. It's crucial peace of mind. Now, step 2 is where people kind of get confused, but it is vital: choosing the right tax account. If your broker is the supermarket, the tax account is the shopping cart you use. You should always use tax-advantaged carts first. If your employer offers a 401k match, take it. Seriously, if they match your contribution up to 6%, that is a guaranteed instant 100% return on your money. Nowhere else in the world will you get that. After that, look at a Roth IRA where your money grows completely tax-free, or an HSA, which offers a super rare triple tax advantage for medical expenses. Only after utilizing these should you move on to a standard taxable account. So the crucial point is, what do you actually put inside those shopping carts? As a beginner, picking individual stocks, like trying to guess if Microsoft or Tesla will have a good year, is risky. If that one company has a bad year, you lose. Instead, we use ETFs, or exchange-traded funds. Basically, an ETF is a pre-packaged basket of hundreds of companies that you can buy with just one click. For example, if you buy an S&P 500 ETF, like VO or VTI, you instantly own a tiny slice of the 500 biggest, most successful companies in the United States. Apple, Google, Amazon. You own a piece of all of them. This drastically lowers your risk because you're diversifying. If one company stumbles, the other 499 are right there to hold your portfolio up. Now for step 4, the automation. This right here is the secret sauce. I want you to adopt the 10% rule. No matter what your income is, whether you make $10 from a side hustle or $10,000 a month from a salary, commit to taking 10% of that and automatically sending it to your investment account to buy your ETFs. Set up a direct deposit or an automated transfer on the 15th of every month. Why? Because it builds the discipline muscle. It forces you to pay your future self first before you even have a chance to spend that money on things you don't need. Over time, that 10% habit will become completely unnoticeable to your daily budget, but the wealth it creates, it'll be absolutely staggering. Section 3, the armor mastering the volatility mindset. Now, what's really interesting about this slide is that having the perfect blueprint is useless if you panic and abandon it the first time the stock market drops. And trust me, the market will drop. We need to master the psychology of investing. The math is easy. It's the emotions that ruin people. Let's equip you with the mental armor you need. There is a profound truth hidden in a famous exchange. Jeff Bezos once asked legendary investor Warren Buffett, "Your investment strategy is so simple. Why doesn't everyone just copy you?" And Buffett replied, "Because nobody wants to get rich slowly." This is the ultimate truth of the market. The strategy I've just outlined for you, buying ETFs every month and holding them, is frankly quite boring. It doesn't give you the adrenaline rush of day trading. But boredom is the price you pay for guaranteed long-term success. If you can accept that real wealth takes decades to mature, you have already defeated 90% of the emotional traps that destroy other investors. Part of building that mental armor is stepping up from a beginner to a sophisticated investor by understanding market regimes. Now, you don't need an economics degree, but you should know that the economy operates in cycles. When you hear experts talk about data points like the yield curve, the federal funds rate, or leading economic indexes, they're simply trying to measure where we are in that cycle. Are we in an expansion phase, or are things tightening up towards a recession? By having a basic awareness of these cycles, you won't be caught off guard when the news starts screaming about a recession. You'll know it's just a normal part of the macroeconomic rhythm, not the end of the world. And because it is a cycle, you absolutely must understand this concept. The stock market is exactly like a roller coaster. Market drawdowns, where the overall value of the market drops by 20 to 40%, are a completely normal historical occurrence. They happen. But the absolute worst thing you can do when the roller coaster dips is to jump out. If you panic and sell your investments, or if you stop your 10% automated contributions during a drop, you are locking in your losses. In fact, a market drop is a massive opportunity because you're essentially buying those same great companies on sale. Keep your hands inside the ride, stick to your automated plan, and ride the recovery back up. Let's move to and see how this builds into an incredible tax advantage. Remember how we said day trading is a trap? Well, this is one of the biggest reasons why. The government taxes you based on how long you hold an investment. If you buy a stock and sell it for a profit in less than a year, that is a short-term capital gain, and it's taxed at your ordinary income rate, which can be as high as 37%. But if you hold that investment for more than a year, which is exactly what our long-term strategy dictates, it becomes a long-term capital gain. The government literally rewards your patience by taxing those gains at a much lower, favorable rate, usually between 0 and 20%. By simply doing nothing and holding your ETFs, you legally keep a massive portion of your money out of the taxman's hands. Furthermore, active traders constantly run into hidden nightmares, like the wash sell rule. This is a really tricky tax rule in the US. Usually, if you sell an investment at a loss, you can use that loss to lower your tax bill. Makes sense, right? But the wash sell rule says that if you sell at a loss and then buy that exact same asset again within 30 days, you are totally disqualified from claiming that tax deduction. Active traders trigger this all the time, completely messing up their tax returns. For us long-term investors, we rarely even have to think about this rule because our strategy is simple, clean, and slow. We avoid the headache entirely. And that patience leads to the most powerful force in finance: compound interest. Imagine pushing a small snowball down a long snow-covered hill. At first, it barely gathers any snow, but as it rolls, it gets larger. And because it's larger, it picks up snow even faster. By the time it reaches the bottom, it's a massive boulder. That is exactly what happens when you invest that 10% every month. And more importantly, when you automatically reinvest the dividends, the little cash payouts the companies give you, back into buying more ETFs. In the first few years, the growth feels slow, but give it 2 or 3 decades, and the snowball effect completely takes over. The money your money is making starts to dwarf the money you originally put in. So we arrive at the final question. You now have the blueprint. You know to use secure brokers, maximize your tax-advantaged accounts, buy broad index ETFs, and automate your 10% monthly contributions. You know that boredom is your friend, that market dips are just sales, and that patience legally saves you thousands in taxes. The noise on social media will constantly tell you to trade fast and panic often. Are you ready to ignore that noise and trust the proven process? You have the blueprint, but the ultimate question is, will you build your wealth machine today, or will you let another year of inflation silently steal your future?